It's time to talk about wealth taxes. Some people love them, some people hate them. Me personally, I don't actually feel particularly strongly about them, but what I do feel very strongly about are bad arguments. And when it comes to wealth taxes, there is enough of those to go around. And one thing that's basically guaranteed to come up whenever wealth taxes are discussed is the issue of capital flight.
If half of the 123 billionaires of New York City leave and move to Florida, how much tax revenue will New York City lose?
This idea that the rich will just leave is a little bit ridiculous.
Critics argue those policies are what's driving businesses and what's driving residents out of their states.
Only a small fraction of the wealthy would ever, in reality, move as a consequence of tax.
If you raise the taxes in any jurisdiction, you're going to incentivize flight.
So one side says that rich people basically evacuate your country like rats fleeing a sinking ship the second you touch their wealth at all. And so basically you don't raise any money at all with wealth taxes, maybe you even lose some. And the other side says rich people barely even care if you tax them, and even if they would, they couldn't really move their wealth out of the country since most of it is immobile wealth, like land at flats and stuff like this anyway. And I just want to be clear what the intention of this video is, because I don't want to tell you whether or not you should hate wealth taxes or you should like them and support them. I just want you, whether or not you argue for them or against them, or whether or not you don't care at all, to have the correct factual basis to make the best possible argument, if that makes sense. I just want people to stop parroting the same brain-dead talking points that they picked up from their favorite ideologue. Okay, all that being said, let's actually answer the question of this video. Do rich people actually leave when you tax them? So as usual, the answer is it's complicated because we don't actually have particularly a lot of data on this issue. Partly this is because there just isn't a lot of wealth taxes. And in fact, there's a declining amount of wealth taxes. In 1995, I think there were something like 13 countries that did tax wealth, but by 2018, I think only 4 remained. And I think in the same time frame, there isn't a country that didn't have a wealth tax and that passed one. So we don't actually have a country that we can look at to see how people behave when you start taxing their wealth. Another issue is that nobody actually really tracks the wealth of individuals, and particularly for the upper crust of society, this can be quite difficult. They tend to be a little bit secretive about those things. And when you want to study whether or not people actually leave in response to one, you also need one more thing, and that is you don't just need all this data for your country, but you need it cross-border because you're dealing with migration here. You get the point, studying this is difficult, but there are a few things that people can and have looked at that tell you a little bit about how people react when you tax them. Like for example, how do people react when you tax their income and not their wealth? Because, you know, income and wealth taxes are pretty different, but at the end of the day, taxes are taxes, and so they're similar enough, you can compare them. Athletes and entertainment personalities, for example, are somewhat famous for moving to Monaco as soon as they make significant amounts of money to save some taxes. And it turns out this issue has actually been studied, and these guys have zero issues ditching their country for a few extra bucks in tax savings. So we have some evidence on this from Denmark, where they introduced a favorable tax scheme for high-earning foreigners that came into the country. And as you can see, after Denmark introduced this favorable tax scheme for foreigners, which is represented here by the vertical red line, the number of foreigners in sports and entertainment for the top 1% of income earners just exploded. The numbers here are normalized to 1990, but this makes it quite easy to interpret, because now we can say that in 2005, the number of foreigners in sports and entertainment in the top 1% of income earners was more than 10 times higher than in 1990. And you can see that there's a real divergence happening here around the time that they introduced this tax scheme, which suggests that the tippity top of the income earners react much more strongly than even people who just earn a good income. But this is a bit misleading. I showed you the foreigners in sports and entertainment graph first, because these are kind of the most famous examples, and there's a good reason for it. And these people just tend to be much more mobile because their income isn't tied to a specific country. If you look at all other regions, you can definitely still see a migration response in the 1%, but also in the lower thresholds, even though it's a bit less pronounced there. But it's much weaker than it was for the sports and entertainment personalities. They also did a similar thing for top inventors in Denmark and the US, actually, as measured by their patents. And as you can see, inventors also tend to be quite mobile when it comes to their tax burden. And this response is even bigger if you measure it not between different countries, but within the same country between different jurisdictions. If you look at the US, for example, you have this graph, which doesn't look worse than the Danish graph at all, but you have to keep in mind that the red line here doesn't represent the same intervention. If you look at the mobility elasticity which is kind of a number that tells you how big this migration response to taxes is, you can actually see that it's quite a lot bigger than the Danish example. Another interesting case is from the UK, which made the news a couple years ago for changing how non-domiciled foreigners pay taxes there. And I remember this being covered quite negatively, at least in my feed. There were a lot of posts about how many millionaires and rich people would leave the UK and how much less tax revenue they would generate. And that is true, a lot of people left the UK, but it turns out, when you study it, and there's a paper studying now, that the migration response is actually quite a bit more modest than people were initially suspecting. The paper found that really only few people leave the UK, and those that do generally tend to continue reporting some UK income, and so they continue paying some UK taxes. And the authors of this paper estimate that the tax revenue loss was far too small to offset the gains in tax revenue. So this paper estimates that the reform generated about £311 million of tax revenue, additional tax revenue, in 2020 alone. So it seems like, at least for income taxation, we actually have some mixed evidence. It seems like people do leave, and they leave in significant enough numbers to, become noticeable, but generally they don't move enough for it to become a tax revenue loss. At least that's what the preliminary UK evidence says. But does this change when we look at other taxes, maybe taxes that are more similar to a wealth tax in their structure? So there's a study that we can look at that investigates how Forbes 400 billionaires move across the US in response to a change in the state estate tax in the US. It's a mouthful. So estate taxes are quite similar to wealth taxes. You don't pay them yearly, but once you die, a big bill is due on your entire wealth. And so in a way, they're a bit easier to avoid than wealth taxes because you only need to be in the right place once when you die. But also in a way, it's a bit harder because you don't generally know when you will die. Fun fact, there is actually some evidence that people react to changes in the estate tax by literally dying earlier or later, depending on what is tax advantageous. Or at least they're doctoring their death certificates in a way such that the tax applies to them differently. But so the suspicion that some people, especially billionaires who are quite mobile, might move when you tax them like this is quite reasonable, I think. And it turns out that the paper finds that billionaires definitely do move in response to these estate taxes. But this is where it gets interesting. Because the mobility response, so how much of the wealth moves away in response to getting taxed, is actually not big enough to be a tax loss for most states. This is different state by state because states have different income tax brackets, and so rich people generally pay more in some states than in others. The math is a bit more complicated, but generally the paper finds that the only state which would not benefit from having an estate tax is California, the state with the, at least in that time frame, highest top marginal income tax rate. Now, this is a bit counterintuitive because California does of course have a lot of rich people, but again, it's the income tax that they already generate from these rich people that makes it not worthy to tax their estates, because they do move away. But this finding is interesting precisely because it reaffirms what we saw in the UK with the non-domiciled income tax changes, and that is that people definitely do move away, but they don't do so in large enough numbers to not make the tax worth it from a revenue side. So the state would have more tax revenue if they tax the states. Okay, but that's income tax and estate tax, but I said at the start that there is still 4 countries that actually do have a wealth tax. Can we look at those? And the answer is yes, because as it so happens, the countries which do have a wealth tax, notably Switzerland and Spain among them, do have some changes over time in those taxes, and so we can see how people respond to those changes. And the finding here, once again, is pretty much the same thing. So people definitely react to the tax, either by moving or by finding other ways to evade the tax. The amount of taxable wealth drops measurably in response to those taxes. But the combined effect of those things is still not large enough to offset the gains that the canton in this case gets by implementing the tax. But there's one study which brings yet more nuance to this, which I want to highlight, and it's about the response to the abolition of the Swedish and the Danish wealth taxes. So this paper is interesting because it actually tracks the international migration, so not just between different regions, as was the case in Switzerland, but also because it actually tries to take into account the negative second-order effects of rich people leaving, such as closing down their businesses. They once again find that people definitely do leave, but not enough to actually decrease the tax revenue as is often claimed. And furthermore, they find that most of the negative second-order effects, such as unemployment from business closures, for example, are actually absorbed by other domestic businesses. And so they estimate that for each dollar raised through the wealth tax, only $0.22 are lost to migration responses. Okay, but then where does all of this leave the actual argument? Well, do wealthy people leave when you tax them? Yes, definitely. But do wealth taxes still raise money even though people leave? Also, yes, definitely. But this doesn't mean that wealth taxes are good just because they raise money. Raising the taxes on life-saving medication would also raise money. And compared to other taxes, wealth taxes seem to be quite inefficient at raising money. In fact, the last study, the one that found that you lose only 22 cents to migration for each dollar that you raise in wealth taxes, found that once you take into account other effects, the picture changes quite a bit. Using the methodology from another paper, the authors find that about 54 cents are lost for each dollar through other channels such as changing in savings and investment behavior, as well as tax evasion and tax avoidance. And so this means that for each dollar that you raise in wealth tax, you really only get to keep less than 1/4 because the rest is lost through some other channels again. But this is also not an argument against wealth taxes overall. You can, for example, fix some of those migration responses if you manage to coordinate your wealth taxes between multiple countries so that you limit the migration response. Or you could do what the United States does and simply tax everyone who is a citizen independent of where they live. And there's of course also arguments for a wealth tax that are completely independent of whether or not it raises revenue or not. But the question of whether or not people move when you tax them is a very legit concern, and it needs to be discussed when you decide on whether or not and how to implement a wealth tax. And it certainly needs to be discussed when you form your expectation how much revenue such a tax actually earns. This all might sound very nitpicky to you, but economic policy is shaped by public opinion and has very real consequences. So I think it's important that people are actually informed about the consequences of these decisions. And so if anyone tells you that wealthy people don't leave when they're taxed, or that all wealthy people immediately leave the country and so you can't raise any revenue, please ignore them. These people are either ideologues or they just lack the required understanding to talk about these issues, and so they shouldn't be taken seriously. Cheers.